Let me tell you about a guy named Marcus. Marcus is 29 years old. He's got a decent job, a growing family, and a dream of finally owning his own home. He's been saving up for years, but every time he gets close to having a down payment, something comes up. The car needs repairs. The kids need new school supplies. Life happens. Then one day, Marcus sees an ad that changes everything. Buy a home with 0 down. Move in this weekend. His heart races. He calls the number. A smooth-talking salesperson walks him through the numbers, and it all sounds surprisingly affordable. The monthly payment is only a little more than his rent. He signs the papers. He moves in. Marcus thinks he just won. But here's the thing nobody told Marcus. That 0 down deal didn't give him a shortcut to wealth. It handed him a financial anchor that's going to drag him underwater for the next decade. And the scariest part? Millions of middle-class families fall for the exact same trap every single year. If you've ever been tempted by 0 down offers, on a house, a car, furniture, appliances, anything, stay with me. Because what I'm about to show you might completely change how you see these deals. And if you find this video useful, hit that subscribe button. We break down money, psychology, and wealth building every single week in a way that actually makes sense. Here's the belief that gets people into trouble. Most of us were taught that the goal is to get the thing, the house, the car, the couch, the TV, whatever it is. The finish line is ownership. And if someone offers us a faster path to that finish line, it feels like a gift. 0 down plays directly into that belief. It says, you don't have to wait. You don't have to save. You can have it right now. And that's incredibly powerful because waiting is hard. Saving is hard. Watching your friends buy homes while you're still renting feels defeating. There's a psychological term for this. It's called present bias. Our brains are wired to value what we can have today far more than what we can have in the future. A house today feels infinitely more real than a better financial position 5 years from now. So when 0 down comes along, it's not just selling you a house or a car. It's selling you relief. It's selling you the feeling of having made it. And that feeling is worth a lot, which is exactly why lenders use it. But here's what they're not telling you. 0 down doesn't mean 0 cost. It means all the costs are just hidden inside the deal. Let's break this down with a simple example, because the numbers here are what really tell the story. Imagine 2 people. Sarah and James. They both want to buy the same $300,000 home. Sarah saves up for 2 years and puts 20% down. That's $60,000. Her loan is for the remaining $240,000. At a 7% interest rate over 30 years, her monthly payment is around $1,597. James takes the 0 down option. His loan is for the full $300,000. Same 7% interest rate. His monthly payment is $1,996. On the surface, that's only about $400 more per month. But here's where it gets real. Over 30 years, Sarah pays roughly $335,000 in total interest. James pays nearly $420,000 in total interest. That's almost $85,000 more, just because he didn't put anything down at the start. But wait. It actually gets worse for James. Because he put 0 down, most lenders are going to charge him something called PMI, private mortgage insurance. This is basically a fee you pay to protect the lender because they consider you a higher-risk borrower. PMI typically runs between $100 and $300 per month until you've built up enough equity. So add another $200 a month for the first several years. That's potentially another $10,000 to $15,000 out of his pocket before PMI even drops off. And here's the part that really stings. Because James put nothing down, he starts with 0 equity. Sarah, on day 1, already owns $60,000 worth of her home. That's $60,000 in real, usable wealth. James has 0. Literally nothing. If the housing market dips even slightly and he needs to sell in the first few years, he could end up owing the bank more than the house is worth. That's called being underwater, and it's a terrifying place to be. Now, I used a house as the example, but this exact same trap shows up everywhere. zero down on a car. Suddenly, you're paying a higher interest rate, and you're immediately upside down, meaning the car is worth less than what you owe. You drive off the lot and instantly owe more than you could sell it for. Zero down on furniture. Buy now, pay later. No interest for 12 months. But if you haven't paid it off by month 12, you get charged all the interest that's silently accumulated the whole time, retroactively, in one brutal lump sum. Zero down on appliances, electronics, mattresses. Same story with different packaging. The zero is always a lure. The cost is always somewhere else. So why does this keep working? Why do smart, hardworking people keep falling for it? It comes back to something called mental accounting. This is a concept from behavioral economics, the study of how people actually make financial decisions, not how they're supposed to. Mental accounting describes our tendency to treat money differently depending on where it comes from or when it shows up. When a lender says zero down, your brain mentally accounts for the cost as zero. Even though intellectually you know you'll be making payments, those future payments feel abstract, distant, almost unreal. The $0 you're spending today feels very, very real. It's the same reason people will drive across town to save $10 on a $20 item, but won't negotiate to save $500 on a $30,000 car purchase. The proportion feels different even when the actual dollar amount is wildly different. And lenders know this. They've studied it. They've optimized their offers around it. The zero is not there to help you. The zero is there to lower your psychological resistance long enough for you to sign. There's another force at play too. And this one is subtle. It's called the endowment effect. Once we feel like something is ours, we value it more. Once Marcus is in that house, sleeping in that bedroom, grilling in that backyard, it becomes his home, emotionally. And that emotional attachment makes it very hard to think clearly about whether the deal was actually good. The feeling of ownership comes first. The full cost becomes clear later. Here's the deeper truth that most people never see. The zero down trap isn't just about one bad purchase. It's about what that purchase does to your entire financial life going forward. When you buy something with zero down and stretch your budget to cover the higher monthly payments, you leave yourself no room. No room for emergencies. No room for investing. No room for opportunity. Think about it this way. Every dollar that goes toward higher payments, PMI, and extra interest is a dollar that's not going into a retirement account. It's not buying index funds. It's not building savings. It's gone, silently paid to a lender who offered you zero on day one. There's a concept in finance called opportunity cost. It simply means that every time you spend money one way, you give up what that money could have done somewhere else. That extra $400 a month James is paying versus Sarah. If Sarah invested that difference in a basic index fund for 30 years at an average 8% return, she'd end up with over $600,000 in additional wealth. $600,000. From the difference between zero down and 20% down. The zero doesn't just cost you more on the loan. It costs you a completely different financial future. And the middle class trap is this. We chase the feeling of wealth, the big house, the new car, the fresh furniture, before we've built the foundation of wealth. And in doing so, we lock ourselves into payments that prevent us from ever actually building it. Marcus got the house, but he didn't get ahead. He got locked in. So what do you actually do with this? First, reframe what zero down really means. It doesn't mean free. It doesn't mean you're winning. It means you're borrowing the down payment too, at interest, for the full life of the loan. Say that out loud next time you see a zero down offer. I'm just borrowing the down payment. Suddenly, it sounds a lot less exciting. Second, understand the real math before you sign anything. Ask 3 simple questions. What's the total amount I'll pay over the life of this deal? What's the monthly cost, including all fees and insurance? How much equity or ownership do I have on day one? Those 3 questions will cut through almost any marketing trick. Third, if you can't put at least something down, it might be a sign that you're not quite ready for that purchase yet. And that's okay. Waiting is not losing. Waiting while saving is building. There is a version of you 2 years from now who will have way more options than the version of you who signed something today just to have the thing sooner. Fourth, if you're already in a zero-down situation, don't panic. Focus on building equity as fast as possible by making extra payments toward your principal. Every dollar you throw at the principal saves you multiple dollars in future interest. It's one of the highest guaranteed returns available to any regular person. And finally, start looking at every financial offer through the lens of what it actually costs, not what it seems to cost up front. The most dangerous number in personal finance is not the highest price. It's the one that's been made to look like zero. Marcus is still in that house. He loves it. His kids grew up there. But 10 years in, he ran the numbers one night, something he probably should have done before signing. He realized he had paid nearly as much as the original purchase price and still had 20 more years left on the loan. His neighbor, who waited 2 years and put 20% down, had already built 6 figures in equity and was starting to invest seriously. Same neighborhood, same houses, completely different financial trajectories. The zero didn't cost Marcus nothing. It cost him a decade of wealth-building momentum. That's the trap. Not the purchase itself, but the invisible delay it puts on your ability to actually build wealth. The goal isn't to have the thing sooner. The goal is to have everything and not be underwater when you do. Think about every zero you've ever been offered. Was it really a gift? Or was it just the cost dressed up in different clothes? If this video made you see money differently, share it with someone who needs to hear it. And subscribe for more videos that break down the psychology behind the financial decisions most people never think twice about. See you next week.